Hey, can we use one of the slide answers? That's amazing. I guess that might show up because it doesn't show up. Peter. I put my and then once that for this one program. Several months. When did you know that was Well, good afternoon, everyone. It's so good to see you here today. We're very glad that you've come out to our first of this year FinTech Lecture Series. So we're excited for our speaker and very glad that you are here. For those of you that are joining us via Zoom, if I could ask you at this time to please be sure that you have muted your audio, that would be wonderful. And at the end, if we do take questions, if we have time for that, we will use the chat function. So again, those of you on Zoom, please be sure to mute your audio. Thank you very much. At this time, I've had a wonderful partner in crime. And by the way, my name is Brock Schroeder, Senior Director of Recruitment here at the Weatherhead School of Management. And I've really been excited to work with Relitza Petkova. She is a professor here in banking and finance, and she has put together a fine set of lectures that are coming up this year. Our next one will be, I believe, on December 9th. And so we're doing it the second Friday of every month at noon. And so we'd like for you to keep checking those out. We'll be putting up the posters here in the lobby. So again, check those out or watch for them online. But we're glad that you're here today and joining us for this FinTech lecture. And at this time, I'm going to turn it over to Relitza so that she can introduce our speaker. Thank you.
Thank you. Is there a microphone?
He has it actually.
Oh, never mind. Hello, everyone. Thank you for coming. We are very happy to have Peter Zimmerman with us. Peter is a research economist at the Cleveland Federal Reserve Bank, and he holds a master's degree in economics from Trinity College in Dublin. He also has a PhD in financial economics from the Said Business School at Oxford University. So obviously he's very accomplished. He's doing research in fintech, banking, and other topics like that. And today he will talk to us about, whether there is a future for cryptocurrency to be used as money, and what is the potential form that may take going forward. And I believe with the recent events in the crypto market, his lecture is particularly relevant. And also, I think the material he's going to present on fits very nicely with the finance curriculum. So as you know, we have been expanding our offerings to include the most recent developments in the fintech space. So we have a course on cryptocurrency and blockchain. We have a course on artificial intelligence and how it relates to financial modeling. There is an algorithmic trading course coming up in the spring. So, as the market is changing, we keep adapting and we keep our curriculum fresh. So in that context, we're looking forward to Peter's talk. Thank you.
Okay,
Thank you very much for the introduction. Hopefully you can all hear me. It sounds like I'm mic'd up. I'll try and sort of around that you're surrounding me, so I'll try and make sure you can see me at various points in time. As just said, my name is Peter Zimmerman. I work at the Cleveland Fed. So I have a disclaimer I need to give, which is that I'm just going to talk about my own views today. I'm going to talk pretty much about my research agenda. Nothing I say is indicative of anything the Cleveland Fed believes in, anything the Federal Reserve believes in, and I'm not going to, feel free to ask me questions, but I'm not going to be looking at very hand-in answers if you ask me about Federal Reserve policy. But apart from that, I'm happy to talk about my own views, and I'm happy to take questions as we go. Today I'm not going to get very technical, either in terms of economics or in terms of technology, but I'm going to talk mainly about ideas and how I think about these concepts, and hopefully, that will be interesting to you guys. And if if you're interested in any of these topics, feel free to email me or to look into some of the sources that I discuss. I'll put these slides up probably sometime over the weekend, so if anyone is interested in seeing more, seeing the notes that I've made, then they will be accessible. Okay. Work. Maybe not.
The button on the side, flip off. No.
Use the keyboard.
Yeah, you can use that.
That works.
There we go. That the arrow.
Okay. Okay. So this is basically what I spend all my time thinking about. When Bitcoin was introduced, this is the famous white paper by Satoshi Nakamoto in autumn 2008. He, or possibly she, called it a peer-to-peer electronic cash system. So Nakamoto very much had in mind, he introduced it as money. This would be a form of money that you can use electronically, online, without the need for a central bank or the need for any kind of commercial bank. I don't know what to do.
That's okay. Let me take over.
And by the way, it's worth, if you're interested in this topic, it's worth, this paper is very accessible, even to someone like me who knows virtually nothing about technology. It's a short read, it's pretty interesting. Now, more recently, people have been thinking about calling Bitcoin and other cryptocurrencies digital gold rather than digital cash. Now, in the real world, if you think about cash and gold, we think of them as quite different things. Right? Gold might be a speculative asset that you hold because you expect it to appreciate in value or because you want to hedge against the rest of your portfolio. Cash is something you hold because you want to make transactions. But increasingly, there's been more and more talk of Bitcoin as digital gold. Certainly this time, I've been looking at doing this, been interested in the space since 2017, for about 5 years now. And well, this chart is 3 years old, but I can't find a more up-to-date version, but it's going to look the same. This is an estimate of how much of Bitcoin activity is used for various purposes. Exchanges is trading, things like merchant, darknet, peer-to-peer, possibly payments purposes, but you can see they are negligible. And the vast majority of activity in Bitcoin, and it's true for other cryptocurrencies too, is speculative. Okay, so it seems that there's really more digital gold stuff going on than digital cash. And just to see, you can do a simple, this is not very scientific, but you can do a Google Trend search for these terms, and you can see that while digital cash, interest in digital cash hasn't changed very much over the last few years, digital gold has gone up a lot, right? People are really interested in this. And there's something a bit curious about this because, gold appreciates in value because people think it's going to be more useful in the future. But what's the case with Bitcoin? If people aren't using it as a form of payment, then why would you expect its value to go up? Okay, so the case for digital gold, to my mind anyway, requires some sort of fundamental usage. Right? There's got to be something you can use Bitcoin for. Otherwise, what are you speculating on? Okay, so, well, the next 2 slides will have some algebra on them. This is really, I don't know how much finance you guys have studied, but this is Finance 101. So I think most of you probably, if you haven't studied finance yet, you will. So these equations will look very familiar. but don't worry, it's going to be pretty simple. I just want to think about here about how we value an asset and why it will have a positive value. So suppose there's an asset that over time pays cash flows. These can be random variables. So next period is going to pay X1, tomorrow, the day after it's going to pay X2, the next day is going to pay X3, and so on. Then if our discount rate is R, then we can write down the fundamental value as that equation there. I think it's pointer to work. No, it doesn't work. Anyway, it's that equation in the second bullet. The discount rate, if you don't know, is basically how do you value future payments relative to money today? Generally, you prefer to have money today than tomorrow, so R reflects that. So this equation is kind of very basic finance 101 stuff. It works really well for traditional investments like bonds, stocks, where there are cash flows. So I have a bond that's going to pay me $100 a quarter, and at the end of 5 years, let's say it's going to pay me back 100, it's going to pay me back $1,000. Well, I just stick that into this equation if I know my discount rate and value it. Now there are some assets that don't pay cash flows, so like commodities. If I have oil, I have a house. Obviously, that doesn't generate cash flows, but it generates utility. So oil is useful. How much do I value having access to oil? How much do I value having access to a house? Or how much could I rent that house for? So you can deal with this. So where does trading come in? Well, any agent, if we agree on V, then any agent should be willing to buy the asset at any price lower than V and should be willing to sell it at any price higher than V. So the price in the market is going to be V, absent trading costs. If we disagree about V, we might trade. So we might disagree about the distribution of these X's, of these cash flows. Maybe we disagree about how valuable a stock is, how much cash it's going to generate. Maybe we disagree about the discount rate, right? If you expect inflation to be high in the future and that's going to put up interest rates, then your R might be higher than somebody who is more bearish on inflation. So then we might trade because we disagree on V. Okay, well, that's all very well, but we've got an asset. With crypto, we don't have any cash flows, right? Bitcoin or any crypto asset doesn't generate dollars. It's not like a bond that generates or an equity that generates a flow of cash. And you can't eat it, you can't live in it, you can't burn it. So it's not, what is it useful for? How can we value it? So typically the way this might work with a speculative asset is, let's suppose the price today is PT, where T is the time today, and the discount rate again is R. Now I'll buy this asset if I think the expected price tomorrow is higher than the price today, appropriately discounted, and I'll sell a bit lower. Okay, and this is how, in practice, most trading, when we trade equities or bonds, most people probably aren't thinking about fundamental values, but they're thinking about changes in price as markets go up and down. Thank you. But it's very hard to predict short-term movements. I mean, why should the price of a stock or the price of Bitcoin be higher in an hour's time than it is today? I mean, there might be news, and you might have some inside information about that news, you might be changes in beliefs. Very hard to predict these things. So you can think longer term, and you can the equation on the second bullet, you can do it recursively using the law of iterated expectations, and you can, we get a green dot. So those of you in the cheap seats won't be able to see this, but you can see that we can iterate over time as far ahead as we want. Here I've iterated S periods in the future. I can take S to infinity, and then I'm left with basically the residual termination value of the asset. So if there are no cash flows, I'm just left with whatever it's worth at the end of time. If it's a bond, that's easy to think about. That's just going to be the borrower paying the bond back. If it's a house, it could be the sales value of the house. If it's a company, you might think of the value of the company when it's wound up and all its fixed assets are sold off. Now, crypto again doesn't have any of that. It doesn't have any termination value, and it doesn't have any cash flows. So why do I speculate? Well, I mean, surely I buy it because I think somebody else will buy it off me for a higher price. So why would somebody buy it off me for a higher price? Well, maybe they think T plus 2, so I'm going to buy it off them for a higher price, and so on and so on. So this can only work if there are agents who believe that the price is going to keep going up, or if we're selling, that it's going to keep going down. And that's going to last forever. Which is kind of weird. We have this problem that like at the end of time, at the end of infinity, someone is still believing they're going to keep selling this Bitcoin to someone else who's going to value it more than them. And it's not obvious why that would happen when there are no cash flows and no termination value. So this stuff is really tricky to value when we think about sort of fundamentals of finance. It's really not clear why it should have any price at all. And really this is a bubble, right? And I don't mean, you know, a bubble is often thought of in a pejorative way, and perhaps fairly so, but it is a bubble in the sense that there is no fundamental value, there is no termination value, and it's valuable because we think somebody else will buy it off us for a higher price. And bubbles are a bit of a challenge for economists because there's no reason why a bubble should have any value other than zero. Okay, I mean, you could write down beliefs that, you know, where I believe that somebody else will find it more valuable than me, and I also believe that that person will believe that somebody else finds it more valuable for them, and so on, with sort of iterated expectations for, you know, up to infinity. But it's not really, these beliefs are very fragile, and it's a solution to that game is always zero. Right? One equilibrium is surely, I don't think anyone's going to buy it off me, and so it's worth zero, and it's a self-fulfilling expectation because it's worth zero, I don't really want to buy it. But actually there are other assets like this. Okay, some of them may be more familiar to you. I mean, cash, fiat currency is an asset like this. Why do you hold a banknote? Because you think somebody else will value. Why would you hold a $100 bill? Because you think somebody else will give you goods or services that are worth $100. So beliefs are really important there. If you stop believing in the value of that fiat currency, it would be worth nothing. So actually, weird as crypto seems as an asset, maybe it's not so different from a banknote. Gold is often called a bubble. It's been in a 10,000-year bubble, or however long gold has been around for. But it does, one could argue, and this is, not everyone agrees on this, but maybe gold has some utility value. Maybe it's useful in jewelry, it's nice and shiny, we like the way it looks. Some people argue the opposite and say we like the way it looks because it's valuable. So it's, you know, I don't know what the answer to that is, but possibly gold is a bubble, possibly it's not. So how can we think about crypto's value proposition? And, you know, one thing I would say in defense of crypto here is that, you know, I got into this in 2017. Crypto had been around for 8 years. It was really just Bitcoin at that point, really. And I went to a conference in 2017, and Bitcoin was going on one of its regular tears. You can see it there. It looks sort of quaint now, a sort of very small spike. When it was at $20,000 by the end of 2017, it was at about 1,000 at the beginning. And so at this conference, the academic economists were sort of puzzling over it because this was the second time this had happened. There's a, you can probably barely see it, but in 2013, there was a similar spike. If you do this on a log scale, it looks more significant. At the time, it was a significant increase. And so a bubble can burst once, and then it should be worth zero. And maybe a bubble can get inflated again if beliefs change. But I mean, this has happened quite a lot now, right? So just looking at that graph, it looks like we've had 4 or 5 bubbles. You know, now crypto is worth Bitcoin, sorry, is worth $17,000. Well, if you'd bought it at the beginning of 2017, you would still have made about 17 times your money back. It's a pretty good investment in 5 years.
So Peter, I like it when you frame this what the digital gold. Is there a recognition then that it completely failed to provide the service that were supposed to, given the original idea by Sakamoto, that would be a means of exchange, right? So it's almost like people are trying to justify having this asset, but with a different purpose, not because this is going to be a curse, but rather it's going to be a means of speculating. Is this a fair assessment?
Right. I mean, that's what the digital gold folks say. That's kind of their claim is it's not supposed, we shouldn't think of it like a currency, it's just digital gold. But my point here is that if you think of it as digital gold, the only way to rationalize that is that it's a pure bubble asset.
I know, but is there any evidence that at some point this thing is going to take off as a means of exchange?
Right. So the argument could be that I believe there's some tail risk, right? So maybe there's a 1 in 100, 1 in 1,000 chance event that this stuff takes off as a medium of exchange. And it hasn't happened yet, but that's what we're betting on. When we buy crypto, that's what we're betting on this happening in the
But there
future.
were attempts, right? I remember even in Cleveland, I think at Cleveland Heights there was some place in Cleveland Heights that was supposed to accept Bitcoins. Was at El Salvador that pair Bitcoins with the local currency, but
In El Salvador, they're legal tender. But it doesn't seem that experiment's been very successful.
Exactly,
In Ohio, I think in 2019, the treasurer at the time was accepted Bitcoin for tax payments, corporation tax payments. That was deemed to be, there was something illegal about the way it was set up, so it was, but these sorts of things could give it some value, could see it being used as a means of payment. But yeah, so one way to think about it, and then this is the way I think about this, you sort of, you've anticipated what I'm going to say, is that it's although it's not being used much at the moment, it could be a bet on it being used in the future. So if I think there's 1 in 1,000 chance that at some point Bitcoin is going to be, or any crypto, remember Bitcoin, I'm talking mainly about Bitcoin, but it's not the only one. If there's any chance it's going to be used more in the future, then that gives it some value today. There's a non-zero chance. But even then, there's still some mystery about how can you have sort of thousands and thousands of these tokens all with some positive value. I mean, we can have uncertainty about which one's going to be the lucky winner, but it seems unlikely that more than a few of them would ever be used as money.
But as a means of payment, it looks like a horror proposition because it's just you just have something it's going to be extremely volatile, right? So if you receive that thing as a payment, you want to get rid of that immediately. Because...
So okay, two things. So I'm going to come and talk about that and what its value proposition is as a means of payment. But the volatility is it's not clear whether it's inherently volatile or whether volatility is. The question is, why is it so volatile? Is it because it's not used much as a means of payment, or is it not used much as a means of payment because it's volatile, or is there some other reason that makes it volatile?
Now think about that graph there. If I were a merchant that would accept payments in Bitcoin, I would accept the payment and immediately try to get rid of it because I don't want to be subject to those fluctuations.
And it's sort of as people are with hyperinflating currencies and a similar dynamic.
But in that case, they don't have a choice, right? I was in an environment like that before in Brazil. I didn't have a choice. I live in that country, so.
And these things actually are, you may know, in Bitcoin is very popular in places like Argentina, Venezuela, where people don't trust banks and where they are looking for sort of a safe asset or maybe one that's uncorrelated with the other risks that you face from holding bank deposits or holding the local currency. So in that sense, it has some use. Okay, I'm going to come and talk a bit more about why we might use it as a means of payment in the future. Okay. Any other questions before I go on to the next section? Yeah.
It's not really a currency. I mean, just because the word currency is attached to it, because it doesn't meet the fundamental requirements of what a currency ought to be. So a currency has to meet 3 requirements. It's a medium of exchange, it's a unit of account, it's store of value. And it doesn't really, I didn't see his slide, sorry. It doesn't meet that requirement. So, well,
yeah, okay.
I know his other slides too.
So this is, as you say, this is the traditional textbook definition of money. We think of an asset with these characteristics.
So I'm just saying it's not a currency.
Okay.
It's just a medium of exchange.
Yeah, I mean, this is kind of, what's in the textbooks. I kind of, money is one of these difficult things to define, and even though it should be something that economists should understand very well, actually, there's a lot of disagreement about what money is and why it exists and all that sort of thing. It's probably one of the most, I would say it's quite an unsettled question considering it's been around for so long. So usually we think of a currency or money with these 3 characteristics. It's got to be used as commonly accepted as a medium of exchange. It's got to be a store of value. So if you hold on to your money, it's still worth something tomorrow. And a unit of account. So people give prices, people do their accounts in that money. I tend to be of the view that only the first one really matters and the second 2 may be corollaries of it. If something's used as a medium of exchange, then it may well be a good store of value. Or to put it another way, if you have a currency like the Venezuelan bolivar, which is pretty rubbish store of value, I'm still calling it money, still used as money. So we normally think of money in these ways. I'm more persuaded by some of the, I'll talk a bit about these models, but the role of money is being essential in search and matching models in economics. So some of you may have seen this before, but I'm going to talk through a nice example that I made up. So suppose we have an economy with 3 agents. There's a farmer who grows potatoes and needs tractors to do it. There's a chef who uses potatoes to cook meals. And there's a mechanic who eats meals and builds tractors. And these agents meet. Obviously, you can do these models more formally, but the idea is these agents mingle around every period. They meet, two of them will meet randomly, and they will try to think about whether they want to do a trade with one another. So suppose the mechanic meets the farmer. The farmer says to the mechanic, I really like it if you give me a tractor, what I want. The mechanic says, well, I'm not going to give you it for free, it costs me money. It costs me effort to produce it. So what are you going to give me in exchange? And the farmer says, I've got these potatoes. And the mechanic says, I don't want potatoes. Can you cook them for me? No, you need the chef for that. So no trade happens. And the same will happen with any of these other pairwise meetings. If the chef meets the farmer, the chef wants the farmer's potatoes, he can only offer him cooked food, but the farmer wants a tractor. So no trade happens. So this is a problem. How does anything get done in this economy? There's no double coincidence of wants. You never want, whoever you meet, one of you doesn't want what the other guys are producing. So, well, how about this? When the mechanic meets the farmer says, can I have a tractor? I'll give you a potato. The mechanic says, well, I can't do anything with this potato. But in the next period, or sometime in the future, I might meet the chef. And then I have a potato to give the chef, which is the thing he wants. And the chef can give me some cooked meal. And then we're happy. So in this way, the mechanic accepts the potato as payment, even though it's fundamentally useless to him. He's not going to eat the potato, per se, until he gets to save it and meet the chef. So this could happen with any of the three assets. There could be a medium of exchange. Maybe the farmer doesn't want to use the cooked meal, but he'll keep it until he meets the mechanic in the future. But you might think between these three assets, a potato is the best form of money because it's storable, it's transportable, which can't be said of the other two assets. So the potato is not perfect, right? Potatoes aren't all the same. They can rot over time. A big potato might be different to a small potato. So we can do better than this by having a different fundamentally useless form of money, which is, let's say, a banknote. So here's a dollar bill. So let's suppose instead of everyone swapping their good for potatoes, they're going to swap it for dollar bills. So there's some bank that can produce bits of paper. Again, the dollar bill is fundamentally useless. Right? You can't eat it. It doesn't generate consumption goods or anything useful. But you accept the dollar bill because you know in the future you'll meet somebody else who will be willing to accept it from you. In this case, the dollar bill is superior to the potato because it doesn't rot. All dollar bills are the same. It's very light. It's easy to transport. And this is how money emerges. The famous paper on this is Kiyotaki and Wright. It's pretty. You can show this pretty neatly. I think it's a nice way of thinking about money. And we say it makes money essential, right? Because there is no double coincidence of wants in this economy, money is essential. And it sort of rings pretty true to real life, right? I mean, if I go for a coffee, I want to buy a coffee from Starbucks or whatever, and I could say, well, what can I do for you? I could give you an economic lecture in exchange. And they can be like, that's not what I want right now. Just give me some money. If I want an economic lecture in the future, I can pay for it. So, this seems a pretty reasonable model of how we do live our lives. Generally, you do not have a double coincidence of wants. But these days, even sort of money like this has its limitations. I should say, first of all, we can value the fiat money by thinking about the convenience yield. So the fact that the money exists allows trades to be done in this economy, and that's welfare increasing. So that gives the money some value, right? We call it the convenience yield. If I accept $1, I can use it to pay for things in the future that I wouldn't otherwise be able to. And so that gives me some sense of how much it's worth. Electronic money is even better. You can use it online, which you can't do with cash. And obviously we do lots of stuff online these days. There is no transportation cost, there's no storage cost, yeah.
Can we say that it is a kind of barter system between multiple?
So barter would only work if you had double coincidence of wants in this kind of environment. So the whole reason for these search and matching models is that we deliberately set it up in a way that there are no double coincidence of wants here. If the mechanic produced tractors and the farmer was able to produce a cooked meal from the mechanic, then they could barter over those goods and you wouldn't need money. But money is essential here because there is no possibility of the barter.
You're like using the potato or like money as a whatever we are giving away for like in exchange of this thing. So what I'm trying to convey is like, can we use this? Can we say that the potato is the barter thing? It's like instead of that, we
I
are
think what you're saying. I think the way to think about it is maybe that like barter allows, sorry, the currency, the existence of money allows me to sort of barter over time, if you like. So we never have, at any point in time, we never have an output instance at once, but by exchanging for money, I can then sort of effectively barter in the future.
Okay.
I can give up my goods, my production good today in exchange for consumption good tomorrow, and money allows me to sort of transport that over time. Obviously, if all of this stuff, if you collapse this whole model into one period, if you didn't have any time dimension here and everyone's just meeting at once, then you could probably barter.
It's like a kind of a technical thing for a barter system that we are using this money.
Yeah, yeah, but it's not sort of some arcane constraint that economists have made up. I mean, it seems realistic in real life. If you think, like I said, if I want to go and buy a coffee, I don't really have anything to offer that coffee maker. I produce economics research that is not useful to some guy in Starbucks, maybe at any given point in time. So instead we use money and I'll go and give somebody else. I'll give you guys an economics lecture. My employer pays my salary, blah, 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 and in this way, we're all using money to kind of defer the consumption goods. Means production and consumption don't have to happen at the same time, basically. What am I thinking about? And I think most of finance is really about designing things that allow us not to have to do everything at the same time. Okay. Okay, so electronic money, even better than paper money, in many ways. But in our economy, certainly in the US, it's hard to think of any real form of electronic money that's publicly issued. So the good thing about a banknote, this dollar bill here, is that as long as you trust the Fed and the government to know what they're doing, and not to sort of hyperinflate it or anything like that, you're kind of comfortable accepting this. You're not reliant on anybody being solvent. You can go insolvent. You're not reliant on anyone's credit to accept this money. But all forms of electronic money, well, prior to crypto, all forms of electronic money do rely on someone's credit. You can have a bank deposit. You're relying on that bank remaining solvent. And maybe not just solvent, but you're relying on that bank being open. You're relying on their systems working. You're relying on that bank being honest. So there are sort of lots of potential reasons why you might not like this. In addition, the thing that I really want to talk about is that the bank knows what you're doing. Okay, so if I buy a coffee with a $5 bill, then that's it. It's just between me and the coffee shop, and it's a pretty anonymous transaction, and I don't have then nobody else knows that I'm addicted to coffee. If I use my credit card, now Amex knows how much coffee I buy. Okay, my bank knows. Well, I mean, that's okay, it's not really a big deal that I drink a lot of coffee, but there might be some certain transactions where I'm a bit more, I value my privacy a bit. So we think about this in terms of a ledger, like a ledger. Let's imagine there's a ledger that keeps track of how much money everyone's got. Now you don't need that for notes and coins. With notes and coins, I just if I hold a $5 note, then I own that $5 note, and that's all there is to it. Nobody needs to keep track of these things. But with electronic money, there is a central issue at keeping track. When I have a bank deposit, I have a deposit at Citizens Bank. I rely on citizens to keep track of things. Now, Citizens is regulated, so I kind of trust. If citizens screw up, then their regulators are going to fix it. And if the regulators can't fix it, then I might have recourse to courts and, sort of my fundamental rights. So, but all these things require trust. Right? I need to believe that these things are going to be enforced. But what if I have no trust? What if I'm really what if I don't believe in any of this stuff? I don't really have any options when it comes to electronic money. And then even paper money, I'm reliant on the Federal Reserve to maintain the value of that note. So let's talk about trust. This is going to get back to your point about sort of what is the fundamental value of this stuff. So I guess many of you might be too young to, it's so sad for me to think about, many of you are too young to remember the financial crisis, perhaps. You've been watching Ben 10 or whatever. But in 2007, 2008, we did have a financial crisis. You may have heard about it. at the time it was a once in a lifetime thing. And the first time it became big was actually in the UK, where I'm from, when a bank, a not very important bank to be honest, called Northern Rock, failed. And there was a bank run. It was the first bank run in Britain in 100 years. At the time, I was traveling through Japan. I was on a ferry. There was a picture on the TV screen of Northern Rock. I'm like, why is there a medium-sized British bank on Japanese news? I can't really think of any reason for this to be a good thing. It's not going to be about that new mortgage product. So yeah, I found out what this was going on, and this was and then went to work at the Bank of England and helped sort of understand and fix some of this stuff. So these things really shake your faith in an institution, right? When you see people queuing up outside Northern Rock and you've got an account there, you're going to join that queue. And actually, in this particular case, it was in the UK at the time, we didn't have 100% deposit insurance, so it was quite rational to join the queue. Now we have 100% deposit insurance, just as you do in the US. And the FDIC ran a survey. There's just been just published a new version. They ask a large sample of households in the US about their financial arrangements. One of the questions, people who report not having a bank account, why don't you have one? Is it because the bank might give you an account? Is it because you don't want an account? And this is something we're doing a lot of work on. There's some people report things like don't have enough money to meet the minimum balance requirements, so which I think is a particular issue in the US. But you see the second and third most popular reasons are about privacy and about trust. And so the blue bars are for anyone who mentioned this as a problem. So people were asked, tick all the boxes that apply, and then what is the most important reason? So 2/3 of people cited either, there may be some overlap here. So at least 1/3 of people had a problem with privacy and trust. And that's only if there's complete overlap. And then we can also say that 21.6% of people thought that either privacy or trust was the most important reason why they don't have a bank account. Okay. I think this is probably, amongst developed countries, it's probably more of an issue in the US than other developed countries. But it's, it's something to bear in mind, like why don't they trust banks? What's the issue here? And thirdly, events like this don't help. So I don't know if it's a coincidence, this happens in 2007 and Bitcoin launched in 2008. Maybe the time was ready for it. So certainly there was a technology problem that was overcome with the invention of Bitcoin. But also, arguably it became popular because people had lost trust in banks, maybe lost trust in governments, and were ready to consider an alternative form of payment. So here are some of the issues you might think about. You might worry about your bank failing, you might just worry about general trust, honesty, whether the bank is competent and doesn't get hacked. And it might not be about losing your money, it could be maybe you give a lot of information, private information to the bank, that can get leaked. Maybe that's what you're concerned about. I'm not necessarily advocating for any of these points, but I'm just saying this is what, to the extent that you're concerned about these things, it might give you some value to finding a currency that can avoid banks and governments and maintain, and that you don't need to trust anyone. Okay. I'm just going to give some examples here, and some of you may feel differently about some of these examples, but I want to, we think of crypto as being used for illicit purposes, and it often is. It's often regularly used for ransomware, it's used for up on the dark net, it's used for dodgy things, but there may also be legitimate reasons why you care about privacy and why you don't want to trust an institution. So one example is that in states like Colorado, I guess many states these days, there is legal marijuana. There are companies that produce marijuana. They're doing a completely legitimate business under state law, but marijuana is still illegal under federal law. So federally regulated banks, which is most big banks, aren't allowed to have contact with these companies. Under federal law, they would be facilitating a crime. That means if you're a marijuana company in Colorado, you can't get an account at a federally regulated bank. Okay. You could deal with state banks, perhaps. Even they might be iffy about dealing with you, or you might, but generally these companies use a lot of cash and they use a lot of crypto these days. There have been cases of credit card firms denying services to companies that are doing legal activities, but maybe morally dubious ones. So, for example, there's a website called OnlyFans, which apparently deals, you can make your own videos and post them online, and you have your fans, and you can imagine what those videos involve. But it's illegal. It's legal. You know, people are doing it willingly. But MasterCard and Visa considered that this was hurting the reputation of their business, and so they cut off service. And that was sort of a, you know, many of these vendors went to crypto instead. So again, you know, maybe marijuana and, you know, internet videos you consider them morally dubious, but you know, we live in a free society, and you know, as long as you're not breaking the law, you have the right to do these things. But even more fundamentally, not wanting your bank or credit card company to know how you spend your money. You know, maybe you have some illness you don't particularly want people to know about, and you've got to buy medicines, you've got to buy equipment, you don't necessarily want people to know about it. For example, you might want to go to Pennsylvania for an abortion, and you might, you know, need to pay for it. You don't necessarily want the Ohio authorities to know what you're doing, for example. So you might be concerned about these sorts of things, and there are now more abortion clinics accepting crypto as payment. And just as a general, you know, you can say, and I always get this pushback, which is like, well, these are all still, at some stage, illegal or illicit activities, morally dubious. But just ask yourself, would you like it if everyone in this room, and the folks on Zoom as well, could see your credit card statements, could see your bank statements? You know, you're not doing anything, you might not be doing anything illegal or even that interesting, but you still value your privacy. You don't want people necessarily to know about it. So to the extent you're worried about these issues, you're worried about, you know, people in the back office in a bank seeing what you're doing, or hackers releasing information about you online, maybe you'd give a non-zero, you'd pay a non-zero amount to avoid these risks. And this, to me, is the use case for crypto. And I can't think of any other use case. So I really think that this is the sort of thing that at some level gives it value. And even if you don't value any of these things, but you think somebody else might, then it gives value to you, because you know that that other person could buy Bitcoin off you in the future, or buy crypto off you in the future.
What's your opinion on cyber crime, cyber theft, hacking, etc., and the role that cryptocurrencies play in that? So
Yeah.
if all cryptocurrencies were to disappear overnight, I'm not talking about CBDCs, I'm talking about pure cryptos. Would cyber crime, cyber theft, hacking go down significantly? And if yes, isn't that reason enough, in addition to so many others, to just not have these at all?
It's a fair comment. So you may be right. And there is a lot of research on this. Daniel Robetti in Tel Aviv, he's a job market, he's a PhD student, but his job market papers are about sort of showing the link between crypto and ransomware attacks, even crypto and terrorist attacks. So showing that there is clearly a link there. There are companies that study the blockchain and try and figure out how much of it is illicit use, how much of it can be linked to crime. Law enforcement does the same kind of analysis when it's trying to check people. So it is true, it does enable crime. You might argue so does cash. So the fact that we have $50 bills, it's harder. So there are costs to using cash. It's true.
It's harder, I mean, with exactly actual cash.
Yeah, I mean, it's been said, if we didn't have cash, if cash hadn't been invented, it would probably, and someone introduced it now, it would probably be banned. But there is a question about, is the answer to that to ban crypto altogether, which is very hard to do because, obviously, by its nature, it doesn't rely on sort of any legal infrastructure. Or is the answer, like we do with cash, to kind of live with it, see the benefit of it, and to police it? I mean, what I'm trying to get at here is to say there is some welfare improving. There is a welfare improving case to this.
But all these examples are fringe or a niche, right? So there's not much that one would scale based on those reasons for holding.
Could be, yeah.
So, so digital currency is going to be just this small fraction that's going to.
Let me skip ahead to come back to these. Okay, here's the back of the envelope calculation, sort of, because you brought it up. So, how much would we value this thing, right? I mean, you're right, it's fringe, I maybe like 90%, 99% of the stuff that I do, the transactions that I make, I don't really care if people know about it. But there might be a small amount where I do care. Okay, and think about scaling that up across everyone in the world. How much would we be willing to pay? So let's take, I mean, this is really like a rough calculation, but very roughly, total amount of M2, which is kind of a measure of money in circulation, that's sort of bank deposits, checking accounts, money market funds, is roughly, this is really total, like one significant figure, $100 trillion. According to the CoinGecko website, the total cryptocurrency market cap yesterday was about $1 trillion, a little less. So this implies a 0.9% chance that, if this is fair value, and obviously these numbers change a lot, a 0.9% chance is just under a 1 in 100 chance that any given transaction benefits from trustlessness. So in other words, for every $100 I spend, maybe I'm willing to, I require trustlessness for $1.
But here,
And that would justify this valuation.
but here it mixes the two concepts of digital currency and digital gold, right? Because the 935 there probably represents the digital gold, the sense of speculation there.
Well,
What do you
yes,
make of that? Is that a fair bet?
it reflects my expectations that in the future you might need privacy, and
But
so I want
expectation-
crypto today.
Right, but the expectation might not be different from the expectations of tulip price in Netherlands in the whatever 1600s, right? We're completely misguided, right?
Yeah. I mean, nobody can tell the difference between fair value and bubble for this sort of thing.
So is it your hypothesis that a primary reason or an important reason for the existence of cryptocurrencies is because the people who use them are interested in privacy?
Yeah, or believe that in the future, other people will be interested in privacy.
Because I think
It's the case with the digital gold.
the vast majority of individuals using this are of a certain age where they put their entire life on social media. There was an experiment that was done at Yale a couple of years ago where they had students for a free cup of coffee. A high fraction of students were willing to give out all their personal information. I mean, social media has people are actively giving out almost anything and more. I don't see too much concern about privacy anywhere. Online shopping itself is very much it defeats the purpose of actually privacy itself.
Selling a privacy, yeah.
All of online e-commerce
Yeah.
defeats the purpose of privacy. So the same individuals who are here are doing the opposite elsewhere. It seems very incredulous to me, frankly.
I agree there's a lot of evidence that people don't value it much. I'm just saying that they value it at all. And I don't even know if this is a fair value. I mean, I'm making a kind of, this is not necessarily what I believe, I'm making devil's advocate case for it to have a non-zero value. Maybe the true value of the cryptocurrency market should be a tenth of this.
Or zero?
If it's zero, then I'm wrong. Then my argument is.
In terms of the value, so you are reporting of price, because I think we have to
I
keep
mean,
price and value separate. We intermingle the two.
Hence the back of the envelope. I mean, and obviously if you try to sell all of that crypto, you're going to sell it all at the current price. But all I'm saying is, ballpark, we're talking about, this kind of figure. I'm not saying that, in the future, everyone's going to be really into privacy and that's the only thing that would value this kind of valuation. I'm saying it only needs a small fraction of people. And maybe not even, the students at Yale are not necessarily representative of global commerce. Maybe this isn't something that individual people will demand, but companies might demand, hedge funds might demand, governments might demand. Okay. I've only got 10 minutes, so I'm not gonna get through everything, but that's totally fine. I'm just kind of throwing a lot of stuff out here today, but I'm very happy to, it doesn't matter if I don't get to the end, I'm very happy to keep taking questions and about anything you like. So let's talk a little bit about blockchain and how blockchain achieves this trustlessness. Again, I'm not going to get technical, there are great sources for this. I just wanted to share you a representation of the very first Bitcoin block back in January 2009. And Satoshi Nakamoto dated it by putting in, you can see some English there, a headline from the Times, which is a British newspaper, about the Chancellor, the Treasury Minister, bailing out banks. So it helps, he did it to timestamp the transaction, but he also did it to make a sort of a point about why Bitcoin exists. If you want to know more about crypto, probably a lot of you know more than I do about blockchain, I recommend these sources. Matt Levine's recent had a whole issue at Business Week about crypto. a very long essay, but it's very informally written, very entertaining, and it gives you a good intuitive understanding of how this stuff works. Okay, so we call the buzzword is that crypto is not only is an electronic fiat form of money, but unlike bank deposits, it is decentralized. What does that mean? There is no single authoritative version. In my accounts at Citizens own the ledger. They have the transaction of the ledger of all the transactions I've made. And if they make a mistake, then that's my problem, not theirs. If they make a mistake, that's just the new reality. If they say I spent money on, I don't know, a car, then I guess I did. Right, unless I can challenge that. But that doesn't happen with crypto. There's no single body that maintains a ledger. Instead, it's maintained by consensus amongst many nodes, basically over the internet. So there's a bunch of people, and this is pretty much why all cryptocurrencies work. There's a bunch of people who are maintaining local versions of the ledger that may differ slightly, but they reach consensus through some kind of mechanism, and that in some sense gives us the correct version of the blockchain. And they're usually designed in ways, and there's sort of a whole economic literature on this, to show that there's no incentive to deviate, no incentive to get it wrong and try and change the blockchain. Because when you've got, basically the idea is it's strength in numbers. If you have enough nodes working on the blockchain, then any one deviation is going to get ironed out. Now, this third bullet is kind of almost everything I do. It's the thing I'm really interested in, which is that there's a sort of flaw in this model, which is that reaching consensus requires us to communicate over the internet. We need to be able to talk to each other. And if we have too many transactions that arrive too quickly, very hard to do that. We won't be able to agree on the correct copy of the ledger before new transactions arrive. So normally crypto protocols hard code a limited settlement rate. So for example, for Bitcoin, there's a block every 10 minutes on average, and a block can hold about 40,000 payments. That means, it sounds like a lot, but actually that means about 7 transactions per second across the entire Bitcoin network. So there's no way this thing could scale up to be a global currency when you're doing 7 transactions a second. Right? I mean, I don't know how many that would be for each person in the world, but not many, right? And maybe you could use it for like one big transaction a year or something. But there's no case for it. You wouldn't go and like buy coffee with this because it just can't handle that kind of throughput. And that's the thing that I find really interesting about it, is that kind of in order to make it consensus, in order to make it decentralized and have this privacy, have this trustlessness, you are forced to accept the limited settlement rate. And Bitcoin's the oldest and slowest. You can do better, but not that much better. So, for example, there was a Bitcoin conference that had to stop accepting Bitcoin payments for its tickets because they were too slow. So you sort of, it's anecdotal, but if these guys have to admit there's a problem, then maybe there's a problem. It's not just Bitcoin, there's other cryptos too. So Ethereum is the second biggest. What you heard about NFTs last year and this year, sort of that, and I guess another bubble that was obviously stupid. And NFTs are traded on the Ethereum network, on the Ethereum blockchain. So they also have been clogging it up. Here's a graph of Ethereum fees, and you can see. So this is in dollar terms, how much it costs for an average Ethereum. Yes.
Just going back to the point you made earlier, I'm not too familiar with blockchain technology. So, are you saying that 7 transactions per second is kind of the limit? And that's something that's not going to change. It's not like it's getting better over time.
That's correct. Yeah. So the only way to change that 7 transactions, it's an average of 7 transactions a second. The only way to change it would be to change the Bitcoin protocol, which would require at least half of all Bitcoin miners to agree on a new protocol. So these guys, you can't get them to agree on anything. You can't get them to agree on what day it is. There have been, generally the way that's been done is being created what's called a fork, a hard fork. So a new cryptocurrency will be created that has what they see as a better code, and those kind of rebel miners will go off and the blockchains fork off. And this one is the Bitcoin blockchain. This one is now Bitcoin Cash, which was a fork, and then there have been others since then. They can handle more transactions, but they'd be less popular.
Okay. Thanks.
Ethereum's a bit different because the guy who founded Ethereum is still a big player, and he's able to herd people. If you think about sort of a game with many, many players, he's a dominant player and he's able to herd people and get them to agree on changes. So Ethereum is a bit more dynamic, it's able to change a bit more. I'm going to talk about one change recently. But yeah, here's an example, just talking about congestion. You can pay a fee to miners to prioritize your transaction. And this is what incentivizes people to update their ledger, one of the things that incentivizes them. And you can see it's pretty volatile, the fees. An average fee right now is only about, I think $6.80 yesterday. But you can see in the past, it's been as high as $200. And that was a one-day spike. And that can be sort of just due to like, I don't know, miners turn their machines off today for some reason. But you can see generally, you know, it's not so unusual for it to be north of $20, $50 for a single transaction. And what's worse than it being expensive is just not knowing how expensive it's going to be, right? This is really volatile. So it's really hard to get the sort of plan of business on this blockchain if you don't know how much every transaction is going to cost and how long it's going to take to settle.
So Peter, if I use cash, there are no transaction fees, right? If I use my credit card, it's just a few percentage points.
Sure.
So what would it take for these fees to become kind of around the same range, or would they never go down?
I mean, because it's to do with a hard-coded transaction limit. Yeah, I mean, you know, these fees change because of changes in demand for the protocol, maybe due to technical problems at any point in time, but they don't scale. So whether I'm doing a transaction for $1 or for $1 million, I'm going to pay the same thing. Or maybe I would want to pay a higher fee for a bigger transaction, but I don't need to. As far as the miner is concerned, I don't need to. So you could see this as being focused more on large value transactions that maybe I'm not doing too often. But every now and then I really value privacy for a large transaction and I'm willing to pay for it. So I mean, sort of the paper I spent most time of my life trying to show that this kind of settlement constraint is one of the things that gives rise to volatility. So in that sense, volatility is an endemic feature of crypto. You can't avoid it, right? If you constrain settlement, then it's hard to trade, and that makes the price volatile. That's the basic idea. It also means that trading stops people from using it as a means of payment. So you have a weird feedback between financial markets and kind of its usability as money. So I've got a couple of minutes left. I'm nearly done. I was going to talk about central bank digital currencies, but I went. I thought I was likely to run out of time, but I'm happy to answer questions on it some other time. If you guys want to email me, I'll also put these slides online. But one of the things I think is cool is the way to think about money as a kind of trilemma. So a form of money can be secure, it can be efficient in the sense that you can handle lots of transactions, or it can be decentralized. But there's a trade-off, you can't have all three at once. So Bitcoin, or cryptocurrencies in general, are decentralized by design. That in order to make, if you want the decentralization, there's a trade-off between security and efficiency. So Bitcoin, for example, is very secure and very inefficient. A bank account, bank deposit is secure and efficient, like it's easy to make transactions. The bank is incentivized to keep it secure, but it's definitely not decentralized. You're reliant on that bank. And then you can think about a potato or any kind of form of commodity money as being decentralized, because once you've got the potato, it holds its value. And I guess it's sufficient if you can carry the potatoes around, but it's not secure. Anyone can come and take potatoes from me if they're strong enough, right? So you can kind of trade off between these things, and we can put all monetary assets in this. Buterin came up with this, who's the founder of Ethereum. He came up with this trilemma in the context of comparing cryptocurrencies. So I actually think we can compare all currencies, all forms of money in this way. Okay, been through that. And then one thing I want to talk about, because I think this is interesting too, is the environmental damage, which you may have heard about. So right now, Bitcoin is using its carbon footprint similar to the country of Israel, a country of like nearly 10 million people. It's the electrical energy usage is similar to the power consumption of the Netherlands, you know, one of the 20 biggest economies in the world. And you can see even individual Bitcoin transactions use up huge amounts of energy. So a Bitcoin transaction is equivalent to 1.5 million transactions on Visa. So, you know, there's significant externalities here. If we think that the cost of the fees seem high, but actually they haven't even internalized all of the social costs of these activities. And that's because reaching consensus on the blockchain is so, it requires a lot of work, requires a lot of consensus. And it's going to be my last slide, I promise. Ethereum, as I alluded to before, is able to change its protocol because they have a single dominant player. In September, they changed the protocol to this wasn't just to reduce the environmental damage, but it certainly helped with the marketing. It's estimated this reduced energy consumption on the Ethereum blockchain by 99.98%. And this actually reduced global energy consumption by an estimated 0.2%. So this change that I don't even know if many of you heard about it, actually had a huge impact on global energy consumption. Kind of, it just goes to show how big these things are. And potentially it's even if you don't care about crypto at all, it's kind of an issue that affects everyone. Okay, I'm out of time, so I'm gonna leave it there. But thank you very much, everyone. This was great.
Well, Peter, before everybody leaves, I just wanted to give you a gift. Thank you for the free exchange of ideas. This is not a potato, but it's some lovely maybe NFTs. There you go. There you go. But thank you so much for your time today, and thank you for being here.
Thank you.
All right, and thank you everyone for coming. And again, we'll have another FinTech lecture the second Friday in December. So we'll see you then. Have a great afternoon. And if you'd like to stop by and say a question or say something to Peter, please feel free to come on down. Thanks everybody for coming.
Yeah. Manish, that's me.
Hi. Hi everyone. Hi everyone.
Yeah, that's what thank you.
I think somebody may have a question.
So being efficient.
Hello. Am I audible?
Some other perspective too.
That's I just use the word efficient there. I guess I just meant it's easy to make payments. So it's effectiveness as a payment system. Oh yes, that's right. There might be other ways you can think about it, but that's what I had in mind. Did you have something else in mind?
No, I just want to confirm, like, are you referring to the same thing or?
Yeah, that's what I mean, that, like I said, that trade-off is kind of, in terms of what I study, that's really interesting.
And then you say that like these are the transactions which you can make. But however, when we talk about trading cryptocurrency, and you don't limit on that, like people are trading too much on different platforms. So being efficient, not from the perspective of new currency, but from a tradable asset. Efficiency does not say.
You're right, yeah. So if we're trading on Coinbase, we're not using the blockchain. So you're absolutely right. But as soon as you want to move it from Coinbase to FTX, so if you want to take your asset to FTX, you have to go through the blockchain. Thank you.
So I learned from that most economies think that currencies big souvenirs, it's inflation. It's goes down.
But it's still
Interest rates, the reserve rate. And I also heard of some people say that the cryptocurrency realized that endogenous currency that
Sorry,
yeah, I think no decided by the variables. Exogenous variables like the 100,000 is far.
Yeah. On a relative.
I think that is, I mean, maybe there's like somebody somewhere setting a price and there's like a big whale in the market. But in terms of thinking about economists thinking about kind of which fundamental to me, it's not to be what it is. It's convenient deal making that benefit. So in the same way as I'm willing to accept a bank note, and there's a cost of holding a bank check, right? So
So then.
I don't get interest on it. But similarly here, I'm happy to pull crypto for their benefit. That's kind of how I think the endogeneity of the value.
Yeah, there were a few. Ownership rights. I'm trying to read the current.
But then how do you restrict people from doing it? So there is a way to do it.
It's
The E1.
Yeah, exactly. I'll just go get a screenshot.
Yeah. So Yeah, so it's basically electronic format cash, right, just having banknotes, electronic cash. It's interesting that and I don't understand it well enough, but they talked about, people bank account would talk about it programmable. You know, not talk about it. That's true, that's very interesting. Thank you. Thanks. I don't read it. Oh, right. So I think my USB stick out.
I think you got back to see this burger to the desktop.
Yeah, it's like a store. Yeah. So when it's over here, so the professor uses that. Do we have some evidence that we are just giving? Oh, there it goes. And the reader was accepting the rate of payment. So you say that it's similar to like here it's we have cryptocurrency and the person who is accepting the cryptocurrency as a person I'm holding. So both have the same advantage. That is why they are trading in between.
So, yeah, I think that when I think of trading today, I think the trust but if I think it's really valuable tomorrow, so when we speculate, we're sort of trading, we're kind of speculating on how valuable future trustlessness is. Kind of something, I guess, I think
Yeah, so there is, instead of evidence, can we say that in his reply, can we say that like in any interview, someone asks me the same question, and I say that it's just like the stock exchange work and how the people are holding the stock and how they're trading, they're getting benefit out of it. So the person is accepting the payment and the holding, both are getting the benefit, that's why they're holding, that's why they're accepting the payment in crypto and so he knows why the person who's accepting the payment won't get rid of it immediately.
Why would or why wouldn't I have very much?
The person who's accepting the payment, why he would not get rid of it, he's accepting the payment, so he knows the benefits of the currency.
Yeah, well, I guess if the guy buying it from him values it, if we disagree about the value of the currency, then, I think it's valuable, but maybe I don't think it's as valuable as you do, then we shouldn't, I think, value that, and I think it's one.
Yeah. So you can be in this trading stock. But I have this question, in India it was not allowed. So but